Hi everyone, today we're going to talk about accounting for iPhone at Apple Incorporations. We're Group 19 from Class Wednesday, including 财经三王晴、会计三叶安妮, and I am 财经三徐婉慈. This is our agenda. First, we'll give a brief introduction of the case, then there will be some deeper discussion on the presentation questions. Now let's look at the case. Apple Incorporation was first founded by Steve Jobs and Wozniak, who launched the personal computer revolution with Apple II in 1970s. Followed by Apple Macintosh, with its ease of use and brilliant design, they redefined the word personal computer. After Steve Jobs returned to the company, Apple catalyzed the digital media industry with iPod and iTunes. In 2007, Apple introduced iPhone to the world, which is the first smartphone with touchscreen, and its new operation system, iOS. In 2008, with the release of iPhone 3G, Apple also introduced App Store that offer iPhone and iPod users a wide variety of applications. Apple was best known for its technical and design innovation, its premium price products, and its walled garden approach, which stands for its mostly proprietary ecosystems of hardware, software, and peripherals. Now we focus on iPhone's business model. At the moment of launching, Apple announced that they will periodically offer new software updatings and upgrades free of charge to its iPhone customers. In contrast, Mac and iPod users did not receive these kind of free service. Since smartphone users were slow to update their software and only few would buy upgrades, Apple believed what they offer is necessary to increase user acceptance. This also gave Apple competitive advantage while AT&T would run a more effective and efficient mobile network. App developers would have a stable hardware and software roadmap, and iPhone users would benefit from an evolving and differentiated set of features and functions. App Store is a grand slam to the industry. As Steve Jobs noted, we think the phone of future will be differentiated by software. By 2008, Apple was averaging $1 million a day in app revenue. For each app sold in App Store, Apple can get 30% of revenue, and the other 70% belongs to the developers. Due to iPhone's unique business model, different way of revenue recognition was applied. Software-enabled hardware devices, also known as bundled components, such as iPhone, Macs, and iPods, should follow SOP number 97-2 software revenue recognition rules. Since Apple periodically provides free software updates to iPhone users, they use subscription accounting and recognize revenue and cost of goods sold with iPhone handset sales on a straight-line basis over 24 months. However, other products like Mac and iPod immediately recognize revenue and cost at the time of sales. Those subscription accounting have no impact on cash flows or economics of Apple's business. Also, it shows a smoother revenue curve on financial statements. The biggest problem here is that these deferred earnings give investors misunderstandings and has driven Apple shares down nearly 75 points since December 2007 to February 2008. As the illustration shows, basically it's all about matching principle. At the time of iPhone sales, revenue and cost of goods sold are recognized. During the 24 months, additional software products are provided free of charge. Software costs are thus incurred. However, we've known that an expense is reported in the same period as the related revenues. So, should corresponding revenue be matched? The answer is yes. The future update is a separate value to be accounted for separately. There will be more detailed discussion later in question 4. By 2008 Q4, Apple's management believed that the impact of subscription accounting on its financial was too big for the company to ignore, so it released non-GAAP financial results as supplements that gave Apple Watchers their first look at its revenue numbers without the use of subscription accounting, for the purpose of better future performance prediction and for opportunistic reasons. According to the table, these supplementary disclosures show strong increase in both sales and income. More detailed discussion between GAAP and non-GAAP will be in later parts.
Question number 1. What are GAAP and non-GAAP numbers, and what are their impacts on financial statements? To answer this question, we want to talk about the difference between GAAP and non-GAAP revenue recognition of iPhone, in this case first. The iPhone revenue recognition method under GAAP is called subscription accounting. Usually, software and magazine publishing industries were well known for their use of subscription accounting at the time that the subscription was purchased, but only recorded the revenue as each issue was delivered. Since consumers are clearly aware of the upcoming free new software features in the future when purchasing their iPhone, Apple announced to use subscription accounting. Under subscription accounting, Apple recognized the associated revenue and cost of goods sold for the iPhone on the straight line basis over its estimated 24 months economic life. On the date of selling iPhone, Apple's reported revenue only reflected an eighth of the total revenue. And here we can see the sketch chart of GAAP subscription accounting. On the left side, and revenue and cost of goods sold are evenly recognized over 24 months. When it comes to non-GAAP, it allows Apple to estimate the revenue more subjectively, which is the cost plus margin method. Company management could estimate the cost and the margin of the upgrade and defer just that portion of the bundle component sale until the upgrade was delivered. And here on the right side is the sketch chart of non-GAAP method. We can see that the sales and cost of goods sold matches with the cash flow Apple receives better, but it is also more subjective. And now let's take a look at the GAAP and non-GAAP numbers. For net sales, GAAP number is 7.9 billion, and if it's disclosed under non-GAAP, net sales become 11.7 billion, which increased by 48%. And for net income, GAAP number is 1.1 billion, and if it's disclosed under non-GAAP, it become 2.4 billion, which increased massively by 115%. As we all know, iPhone revenue recognition is the main cause of the difference between GAAP and non-GAAP numbers. Now let's take a look at what happens when we change from GAAP to non-GAAP. For iPhone sales, it increased from 0.8 billion to 4.6 billion, which is 475% more. And for iPhone as percent of sales, it increased from 10% to 39%, which is 29% more. As for the impact of using non-GAAP, for Q4 in 2008, when iPhone 3G and iOS 2 was released, net sales, net income, iPhone sales, and iPhone sales as percent of sales all increased in a considerable number. But for the rest 7 quarters in the future, non-GAAP amounts will be lower than the GAAP amounts. Question number 2. Which method best reflects the economic reality? And our answer is non-GAAP. Upon buying a new iPhone 3G, consumer enjoys its hardware and software both. Even if Apple provides free software upgrade, the advantage should not be the same as the original buying. Therefore, straight-line basis of revenue recognition does not reflect the economic reality so well, but it is truly a rather safe and conservative way of accounting. In contrast, non-GAAP reflects the economic reality better because it reported more revenue on selling iPhone, so the net income will match better with operating cash flow. And now let's take a look at the GAAP and non-GAAP EPS numbers. Under GAAP, it is $1.26, and under non-GAAP, it is $2.69, which is a big increase of 115%. We think that non-GAAP revenue recognition best reflects the economic reality because it faithfully illustrates the great performance in Q4 in 2008 when iPhone 3G was released.
In question 3, we'll be discussing whether Apple should lobby for its non-GAAP numbers to be sanctioned by FASB. In our opinion, we believe this is a necessary decision for Apple. Under current US GAAP, Apple faced over restriction on when and how revenue should be recognized. Subscription accounting means that Apple has been under-reporting earnings on its best-selling smartphone for 2 years. What's more, this also made Apple's financial report lacks the transparency necessary to fully inform users making investment decisions. Apple believes that this is one of the factors that kept its share price from fully reflecting the success of their most profitable products ever made. The reason why we think non-GAAP is a better solution for the problems Apple had encountered is that under non-GAAP, subscription model is more simple and clear. Also, it provides more informative, timely, and complete sales performance of iPhone, which fit in with the basic accounting philosophy of faithful representation.
We will now come to the fourth question. Does it matter for the revenue recognition rule for smartphone changes? The question, we have to first understand the nature of smartphones. Nowadays, smartphones are distinct due to different models and functions, and there are bundled components to constitute a smartphone, like hardware, software update, warranty. Therefore, it would be unjustified if we can't afford standard price. Meanwhile, we have to adjust revenue recognition rule with technological changes, so it matters for the revenue recognition rule for smartphone changes. Let's take a look on Apple's revenue recognition policy. There are two distinct policies for Mac and iPods and iPhone. For Mac and iPods, since the company charged for the software upgrade, it recognizes revenue and cost of goods sold for hardware at the time of sale and will record corresponding revenue and cost of goods sold related to the upgrade when the order is occurred in the future. For iPhone, as the company provides new software features free of charge, it uses subscription accounting to record deferred revenue and cost of goods sold, and amortize them on a straight-line basis over 24 months, while collecting cash from iPhone sales at the time of sale. So, what is the motive of the adoption of subscription accounting for Apple's iPhone? It is all about the matching principle. At the time of iPhone sales, revenue and cost of goods sold are recognized. During the 24 months, additional software products are provided free of charge. Software costs are thus incurred. However, we have known that an expense is reported in the same period as the related revenues. Should corresponding revenue be matched? The answer is yes. The future update is a separate value to be accounted for separately. Consequently, in the first quarter, Apple's reported revenues reflected only an eighth of the revenue from iPhone sales. resulting in a deferral of the remaining revenue and cost of goods sold. Like an iPhone 3G of $500, it recorded revenue of an eighth, which is $62.5, and recorded the remaining as deferred revenue. Same treatment for cost of goods sold. So, is there any adjustment needed for the current revenue recognition policy? On the 28th of May 2014, the FASB and IASB issued coverage guidance on recognizing revenue in contracts with customers and to develop a common revenue standard for US GAAP and IFRS. The core principle of the update is to recognize revenue to depict the transfer of goods and services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services, and there are 5 steps to be applied to achieve the core principle. The first step is to identify contract with a customer to indicate rights of the payment parties and payment terms. The second step is to identify the separate performance obligations in the contract. If an entity promises in a contract to transfer more than one distinct good or service, like the entire smartphone and software upgrade to the customer, the entity should account for each promised good or service as a performance obligation. The next step is to determine the transaction price of transferring promised goods or services in which the entity expects to be entitled. The fourth step is to allocate the transaction price to each performance obligation. The transaction price is allocated on a relative standalone selling price basis. Even discounts should be allocated to one performance obligation, rather to all performance obligations. The final step is to recognize revenue when the entity satisfies each performance obligation by transferring control of a good or service over time or at a point of time. All in all, we recognize revenue for each performance obligation when it is satisfied to the customer. Revenue recognition will not be delayed under the new standard. Let's use the iPhone 3G example for demonstration. In year 1, the entire iPhone is $300 out of the price $500, so revenue from iPhone is recorded. Revenue from service and support contracts should be recognized at the time of sale as the service takes place at that time. The $100 are allocated over the 3-year warranty period. For revenue from software update, it is allocated over 2 years. We can see that each performance obligation is identified and recognized separately. Now, we are going to conduct a comparison analysis between the Accounting Standards Update and US GAAP. Regarding principle, there are numerous requirements for recognizing revenue in US GAAP. It consists of numerous industry-specific and transaction-specific standards. Issues about recognizing revenue were often difficult to resolve, while under the new guidance, there will be consistent principles of recognizing revenue, regardless of industry or geography, and then enhancing comparability of revenue recognition practices across entities. And since it is principle-based, it can be applied to all contracts. Moreover, concerning disclosure requirements, companies currently provide limited information about revenue contracts. The new guidance includes a cohesive set of disclosure requirements for disclosing contracts with customers. These will help financial statement users understand the nature, amount, timing, and uncertainty of revenue and cash flow arising from contracts with customers. For accounting treatment, as discussed before, under US GAAP, there is a problem that goods and services are deemed not to be recognized as distinct revenues, but in fact, they represent separate obligations. The new guidance improves the unclear situation, which identifies each performance obligation and recognizes revenue when it is satisfied. We can see that there will be significant changes to revenue recognition to companies selling products and services in a bundle, and especially for Apple. Apple should apply the new revenue standard after December 15, 2017. And the new standard will be introduced into the FASB's Accounting Standards Codification as Topic 606, Revenue from Contracts with Customers. And this is the end of our presentation. Thank you for your listening.